In this video, we're going to talk about your trading edge and understanding how to make money in the markets. Now, that might sound a little bit strange because you think, well, I've got a trading course here and I'm learning all of these technical analysis techniques for entering the markets and all of that kind of good stuff. So I think I understand how to make money in the markets. But what we want to do in this video here is take you a step further. Okay, so take you to the mindset of a professional trader and help you understand how you have to think to be able to make money. Because believe it or not, knowing the system is only a small fraction of what you actually need to be consistently profitable in the markets. And in this video, we're going to talk about the mindset that you need to have to be a consistently profitable trader. So before we get into it, it's important to understand what a trading edge is, okay? Us as traders, we have an edge. What you're looking at here in this course, the techniques that you've learned from this course, gives you an edge in the market. Okay, so it puts you in a good position to be able to take profitable trades, to extract money out of the market. However, you need to understand that that's all it is. It isn't, you don't have a crystal ball. So any trade that we get into could be a winner or a loser. There's nothing that we can do to really know with any certainty what the outcome's going to be. Okay, so you need to understand that you have an edge in the market, but that's all it is. It's nothing more. And an edge is simply a higher probability of one outcome occurring over another. It's not 100% guarantee that if you do X, Y will happen. It's just saying if you do X enough of the time, then Y will be your outcome. So if you think about things like, if you think about a casino, for example, they know that on any one spin of the roulette wheel, they could win or lose money. The punters are people putting down money on the table, they could win or lose. But they know that over enough spins of the table, they will come out on top because they have an edge. Now on a roulette table, yes, they have a slightly larger edge than most other games. But even if you take something like blackjack, for example, as long as the casinos know that they have, a small percentage edge over the people, the punters that are sat down at the table, they're happy enough to continue with that particular game. And indeed, they'll encourage you to sit down for longer because they know the longer that somebody sits down, the more money they're going to make out of them. And that's a way that we need to think as traders. We need to not be concerned with the outcome of just one trade or two trades or three trades. We need to start thinking of ourselves as being the casino and looking at the trades over a larger sample size. So for example, as I just said, not being concerned with one or two or three trades, but instead what happens over 10 trades and 20 trades and 100 trades, because we know that if we have an edge in the market, then the more trades that we take that adhere to our system, the better off we're going to be. We're giving our system a better chance of success and we're allowing our edge to play out. Does that make sense to you guys? So it's important to understand that we have an edge, but it's not a guarantee. It simply puts the odds of success in our favor. A person can take a winning trade without an edge, but similarly, you can take a losing trade with an edge. It doesn't take any skill to come to the market and put on a trade. And, out of sheer luck, you could put on a trade and have a winning trade. Or you could have the best system in the world, put on a trade and have a losing trade. But the outcome of any one trade is completely insignificant. It's not important. You need to start being concerned with the outcomes of many, many, many trades. Okay, because an edge plays out over a number of trades, not just one or two. So the next thing to understand is how are your winners and losers going to manifest themselves? Okay, because there is a random distribution between your winners and losers. Now, as I just said, any one trade can be a winner or a loser. One trade in isolation is completely random as far as we're concerned. Where we have an edge and where we start to see our system play out is over 10, 20, 30, 40 trades. So as I said before, the important result is not that of the individual trade, but of many trades. But even having said that, you need to understand that the distribution between your winners and losses is not necessarily going to be consistent either. So let's say, for example, you have a 70% chance of being right. It doesn't necessarily mean that you're going to make money on 7 out of 10 trades. What it may be is that over, let's say, the first 20 trades, you could take all losses. there's nothing saying that you couldn't do that. It's completely possible. If you take into account the fact that any one trade is random, then any one trade could be a loser, which means that any one of your first 20 trades or all of your first 20 trades, in theory, could be losses. Now, that's unlikely to happen, but I'm just trying to get it into your mindset that you can't measure things over sort of 5 or 10 trades. You need to measure it over 20, 30, 40, 50 trades. That's how you need to measure your edge, okay? So as I said, it may be that your first 20 trades are losses, but then your next 60 trades, you take 60 winning trades on the bounce, and then your last 10 trades are losses. So your distribution between your winners and your losses, they're not going to be consistently evenly spread out. So, take 2 good trades, take 1 bad trade, take 3 good trades, take 2 bad. That's not the way that it works. You may take 5 or 6 or 7 losing trades in a row before you start to take the winning trades. But you need to understand that as a trader. You need to understand that when you're getting into the market, you're getting into the market with an edge. There's no crystal ball. There's no guarantee. And as I said to you on the previous slide, you need to think of yourself as being the casino. So any one hand or spin of the wheel can make or lose you money. But as long as the punter sits down long enough, they will eventually lose all their money. And that's the way you need to look at it. You are the casino. The other market participants are the punters. And if you keep taking your trades and you're consistent with the way that you approach your trades and your trading, then you should put yourself in a very, very good position to come out ahead of the game, to come out profitable over, a long period of time. And that's what matters. It isn't the outcome of today's trading or tomorrow's trading that has any bearing on our success. It's the outcome of the next 10 days trading or the next 20 days trading. That's what you need to start to concern yourself with. So now that you understand what an edge is, and you understand that there's a random distribution between your winners and losses, let's now start talking about your equity curve, which will be a visual representation of everything that we just spoke about. It'll be a visual representation of your edge playing out over a large sample size full of trades. Okay, it will show you that there are a random distribution between your winners and your losses. Now, your equity curve ultimately needs to be viewed like a chart, all right? It's not going to go up in a straight line. There are going to be peaks and troughs or peaks and valleys, if you like. But what's important isn't a single swing in your equity curve. It's the overall trend in your equity curve. So even, let's say, for example, you have some deep swings, so you make a couple of mistakes. As long as the overall trend is up, you're in a good place and you're doing the right thing. You need to remember that we can't avoid losses, all right? But losses, they don't mean that we're trading badly at all. It just means that, we're paying the market for information and we're not getting anything back for it. That's all it is. It's as simple as that, I promise you. Okay, so going on to your equity curve, as I said, it should be viewed like a chart, and you ultimately want to be concerned with the outcome of a series of swings and not just the one swing. So you want to see a series of higher highs and higher lows, showing that your equity is trending to the upside. So let's take a look at an equity curve for the system that we've shown you, that we're teaching you on this course, for the range bar trading system. As you can see there, this equity curve is moving up. This is over 133 trades, as you can see there. So the bottom axis is the number of trades. The top axis is the percentage that the account grows. We've done a very, very simple calculation there. We've taken all of the trades, well, not all of the trades. We took like the middle part of a particular trading record because we couldn't fit it all onto the one screen here. We took the middle part, so as you can see, it's already gone up from 100 there. But we've then shown you the distribution between a series of trades in the sort of like the middle, say 8 or 9 months worth of trading, for example. Now, what's important to understand from this particular equity curve is that, yes, it's going up, but take a look there. There are times when it takes little dips, small dips, not massive dips. Some are bigger than others, some are more pronounced than others, but ultimately it doesn't go in a straight line. Okay, so what you tend to get with any sort of trading is you get periods of time where you're sort of standing still. You're not really making too much, but then you're not losing too much either. And then suddenly you'll get a good market condition where it just bumps you up to the next level. You'll get sort of 5 or 6 trades which all make you money. And then you'll go through a period where maybe you'll take a few losses, You'll take a couple of winners. And again, you're not really setting the world alight. You're not doing a great deal in terms of increasing your equity. And then suddenly a few trades have come along. And again, you get bumped up to the next level. And that tends to be the way that, for our systems anyway, the way that your equity curve looks and the way that it works. You kind of hover around break even, or you hover around a certain point, and then you take a series of trades which then move you up to the next level. And then once you're at the next level, you go through another series of trades where you're not really winning, you're not losing, you're just hovering around your current level before you get moved up to the next level. Now, what does that look like? To me, doesn't that look like price acceptance? So as I said to you earlier, it's exactly the same as a chart. You view it exactly the same way. That's the way you want to analyze it. As long as the trend is up, you're happy. If the trend starts to come down, then you can start to be concerned with things. But even then, you still need to be concerned with the big picture, the overall outcome of a number of trades and not just the one or two. So for example, if we take this middle section in the chart here, so between 41 to 65, that's 20 trades there. And through those 20 trades, you didn't do much at all. The market kind of hovered around break even, and you didn't make any money, you didn't lose any money. But let's say, for example, that you didn't have this previous experience here. So you didn't have this experience of the market trending up over here. So you didn't get to grow your equity here, to have confidence in the system, to know that even though you're experiencing this here, it doesn't matter, because there will be a period of time when the market just shoots up. Okay, if that had been the case, then as a new trader, if you hadn't back tested your system and done some of the things that we taught you during this course, you probably would have thrown this system in the bin just based on that small sample size worth of trades over there. So over 10 or 20 trades, it didn't do anything, you would have thrown it in the bin. And then what? And then you miss out on all of that upwards movement over there. So what I'm trying to stress here, what I'm trying to get at, is that you need to start looking at your equity curve from a big picture perspective. You need to start to understand that over 5 or 10 trades, it absolutely means nothing. You need to concern yourself with the outcome of 30 trades, 40 trades, 50 trades, enough trades essentially. And then more to the point, even before that, you need to have done the necessary back testing to understand that this is the way the system works. This is the way that trading goes. There's nothing that we can do about that to change it. Okay? So now we want to talk about outcome bias. Now, most new traders get into trading expecting to make money, and there's absolutely nothing wrong with that. The problem is that they're expecting to make money on every single trade. Now, this attitude ensures that the trader is going to feel pain when a particular trade turns out to be a loser. Okay? The reason for that is that if you're getting into a trade and you're expecting a certain outcome, then if you get something else, you're going to be disappointed, you're going to feel anger, you're going to feel a whole heap of emotions. So what we need to do as traders is we need to get away from the mindset of trying to be right on every trade. And instead, we need to start focusing on taking the right trades and executing them correctly. Because if our mindset shifts from trying to be right on every trade, and instead we start focusing on saying, I don't care about the outcome, I just care about the execution. As long as I can make the right execution and I can do things correctly for every trade, then the outcome will take care of itself. And by doing that, by focusing on just the execution, you're taking away the market's ability to give you pain. All right? If you're not getting into a trade expecting to be right or expecting to make money, then the market can't do anything to hurt you. Do you see the logic there? If you're getting into a trade and you expect to be right, then the moment that you're not right and the moment that you lose money, the market's done something damaging to you. The market's given you something that you didn't want. So if we take away the market's ability to do that by not being concerned with the outcome of the trade and instead being concerned with the execution of the trade, then we're pushing ourselves in the right direction to be a consistently profitable trader, because we're taking away the market's ability to give us anything negative. If we simply focus on the process of trading and truly accept your risk, your trading will improve. Now, when I say truly accept your risk, the reason that I put it that way is that a lot of you guys will say, well, you know what, I put on a stop loss, so I have accepted the risk because I've put a stop loss on. That's not strictly true. Just because you put your stop loss on, that doesn't mean that you've accepted the risk. It means that you've done it because you've been told that that's what you should be doing, but it doesn't mean that you're happy to lose that. You need to get into a trade, put your stop loss on, and accept that you may have just, kissed that money goodbye. The market may go against you, and that's the end of it. You can only trade profitably if you think that way. If you start thinking any other way, then unfortunately you're going to be putting yourself in a position where the market can do you some harm, and where it's going to have a negative impact on your trading from not only a psychological perspective, but also from your monetary perspective. Okay? So what can we do to get around that? What processes can we put in place to start to think the right way and to start to do the right thing? Well, we've got a few suggestions for you here. The first of which is to trade in sample sizes. So what I mean by that is you need to make a conscious decision in yourself to say, you know what? I'm not even going to look at my bottom line for the next 10 trades. I'm just going to take the next 10 trades regardless of what the outcome is. I'm going to take every trade the same. I'm going to execute perfectly, and then I'll analyze at the end of those 10 trades. Okay, then you can kind of see where your trading's at. Now, ideally, you want to be doing it over more trades, but if you just take it in 10 trade chunks, so you take the next 10 trades, and then the next 10 trades, and then the next 10 trades, you will soon find that actually you're making much better decisions as traders, because you're not concerning yourself with the outcome of any one particular trade. You're interested in the outcome of a number of trades over a larger sample size. Okay? If you're afraid to hold a trade, then you need to trade a smaller size. You need to start cutting your position in half or into quarters or whatever. All right. So if one of your problems is that you can't trade and you can't hold a position because you're always scared to give the money back, you need to start taking a smaller size so that the money, not that it's insignificant, because the money's always going to be important. Okay. So you don't want to just trade nothing, because then you'll make a whole heap of other mistakes. So you want a little bit of money on the table, but you don't want so much that you're sweating about every single tick. All right. So you need to think about taking your trade size down. All right. Just dialing that back a little bit. And then you need to stop getting into a trade to be right. And you need to focus on the process, which is what we talked about on the last slide. This is very, very important. Stop getting into a trade hoping to make money or hoping to be right. Start getting into a trade hoping to make the right decisions, to execute according to your plan. Once you can do that, the profits will take care of themselves. Okay, and by doing that, you're focusing on taking away the market's ability to give you pain. If you're not looking to get into a trade to be right, then the market can't do anything to hurt you. And if it can't do anything to hurt you, then psychologically, it cannot impact your trading. Do you see what I mean? Okay, so a very quick recap there. You need to be concerned with the outcome of a larger sample size full of trades. So start trading in, sample sizes of the next 10 trades, the next 10 trades, the next 10 trades. Start to trade smaller size if you need to, and stop getting into the trades trying to be right. Just focus on the process. And by doing all of that there, you will be taking away the market's ability to give you any pain. Okay? All right, I hope that makes sense for you all. If you have any questions, please feel free to post it below the video. I suggest that you probably watch this video again, because this is one of those topics where a lot of new traders, they kind of say, yeah, that won't affect me because I'm a strong person and all of this. And then it's only after 1 or 2 or 3 years trading worth of pain that you eventually come back to lessons like this and you think, you know what, that kind of made some sense. I should watch that again and I should take that on board. So, let's cut your learning curve in half here. Let's cut it right down. Watch this video again, really start to understand it and digest it. And I promise you, if you can do that, then you will start to make money. Okay? So thank you very much for watching, and I look forward to speaking to you all on the next video. Take care now.